is the model of a pill. Here, pill. Everything that is here comes on the debit side, and whatever that is pill appears on the credit side. So here is expenses, assets, and received, and pill is payments, incomes, and liabilities. Let us see how we can test the application of this rule to the following transactions. I have the first transaction on the board end, which of course is cash purchases of $4,000. Cash purchases. What this simply means is that the business made purchases, and in the process at the same time the business was able to make a payment of $4,000. So I told us earlier on that whether you love this or you don't love it, it doesn't matter. At the end of the day, in accounting, there shall be basically 2 entries from every single transaction. So from this transaction now, we have to create 2 entries, and that means that we need to open 2 accounts. So I'll proceed and do that. The first accounts will of course be cash accounts. You have debit on the left side, and you got credit on the credit side. The credit on the right hand side here. Then I also have purchases account, which got 2 sides as usual. On the left side you have the debit, and on the right hand side you have the credit. So what we need to determine at this level is which account is going to receive the debit entry and which account is going to receive the credit entry. Doing this is literally very simple. If you like, you can start with the cash account, or if you like, you can start with the purchases account. In the case of cash account, it is either of 2 things that happen in business with your cash account. It is either the business is receiving money or the business is paying money. So it is either there is a receipt of money into the cash account, or there is a payment of money from the cash account. That's absolutely simple guess. So in this case, let us look at it. What do we have? Cash purchases $4,000. It simply means that the business is making a payment of $4,000 on purchase. So as far as the cash account is concerned, what we have there is a payment. And the simple thing you need to ask yourself is, what does my rule say about payment? The rule says here pill. So you look at it, there's a payment, it goes this way and lands there. P stands for payment. If you need more explanation on this, I'll advise you go watch the lesson 1 on basic application of the year model. You can have more explanation and information from that video on here. So P stands for payment, and we can see that the rule and the model says that the payment shall be credited. So for that reason, you just proceed to the cash account, and then you say on the credit side you've got $4,000, which is of course coming from where? From purchases. Now, all you have to do in accounting, in generalizing, is be sure of your first entry. You don't need to work so hard to know where the second entry will be, because there is another rule that guides you already, which is what we call the principle of double entry. The double entry rule says that for every debit entry, there shall be a corresponding credit entry. And also, in a vice versa fashion, for every credit entry, there shall be a corresponding debit entry. So once you're sure of the first entry, you're sure you got that right, all you need to do for the second account is transfer the same sum to the opposite side of the second account. So I don't have to think, I just have to follow this simple process. Okay, for every credit entry, there must be a corresponding debit entry. So my $4,000 now gets to land on this side of the purchase account, and I see that is coming straight from the cash account. Then you have the double entry. It's so simple. So if you like, I can say, oh, I want to use my rule, my model to post into the purchases account. And the first question in that case that you have to ask yourself is purchases. What does purchase mean in a business? When you make purchase, it means you are incurring an expense. Purchase is a business expense. So classify this account as an expense first. Then if this account is an expense to you, what is the next thing you have to do? Go to your room and ask yourself, where should the expense be? Here you have, here PO, this is expenses, this is assets, you have this as receipts. So the rule makes it clear that anything that is an expense must always be debited. So the very reason why in the purchases account we have a posted made already on the debit side of the account. This is not something you have to count. I think it's very, very simple, very, very interesting, and of course fun to learn. Okay, so you might be asked in the exam to do journal entries, or in your business you want to make journal entries. Then what do you have? Your journal will always have two columns as usual. You have debit and credit in dollars. Now, if you are doing journal entries, this baffles me a lot. You know, you get ask students that have been studying accounting for 5 years. You ask them, okay, what are the journal entries for this transaction? And they are lost. Like, what are you talking about? Journal entries. Journal entries is very simple. Whatever you have done inside your ledger account, just go and express it in the journal. That's what we call journal entries, okay? But there's no magic to it. But in the case of journal entries, we normally start with debit, then proceed to credit. So, you look at it and say, debit, which account are we debiting purchases? It's a debit purchases, and that is on the debit column. So purchase is on the debit column, you put this on the debit column, $4,000, and then you say credit cash account, which is on the credit side, $4,000. This is your journal entries. Very simple. So your journal entries is talking about which account should receive the debit entry and which account should receive the credit entry. That's what we got for the first one. Let us proceed to transaction number 2. Okay. Transaction number 2. Number 2. Oh, let's say I got paid insurance. Oh, okay, I can do paid stationery in cash. Let's do this. Paid stationery in cash, $20. Paid stationery in cash. As usual, in this transaction, 2 events have taken place. 1, the business bought stationery, and 2, the business made a payment from the cash account. So you open your cash account, okay, once more. But for the purpose of practice or in the exam, you don't have to open your cash account multiple times, okay? You just have to open one large single cash account that can take all your entries or all your postings at the same time. So, but for the purpose of simplicity, I'm going to assume that every time I need to open my new cash account for clarity. So you open your cash account, and next is the stationery account. So look at it. 2 things happen. The business bought stationery, and at the same time, the business made a payment of cash. We talked about this in the last transaction, that in the cash account, there are basically 2 things that can happen there. It is either you receive money into your cash account, or you get to pay money out of your cash account. Nothing more. That's what happens. So in the case of cash account here, what happened? Paid stationery. So that means the business made a payment from the cash account, and that means once again in the cash account, what we've got here, his or payment. That's what we've got in the cash account. Payment. Trace your payment again once more. That takes you to the credit side, and that means that payment should always be credited in the cash account. Then you come down and say $20 on the credit side, and that is what? Stationery. For every credit entry, there must be what? A corresponding debit entry, which is coming from cash account. Then alternatively, how do I post into my stationery account? Stationery is an expense in a business. The rule says debit all expenses. So for that reason, in my stationery account, I have the expense, the transaction being debited. Then you go further to your journal entries and say, what are you doing? Simply, in your journal, what you have done is you are debiting your stationery account, You're debiting your stationary account on the debit column, 20, and then you're crediting your cash account on the credit column, $20. That is your journal entries. Very simple. Very, very simple. Very, very simple. Okay. So the next that we have on the line, that's transaction 3. Let's look at that. Transaction 3 is bought goods on credit from Jane, $1,000. Excuse me. Bought goods on credit from Jane, $1,000. So what do we have here? Number 1, there was a purchase of goods. So open your purchase account, okay? Then number 2, the business did not make a payment. So we bought goods on credit from Jane. We didn't make a payment of cash. So it means that in this transaction, there is no involvement of the cash account. Rather, what do? You have to open Jane account. And that is to keep track of the money that we are owing Jane at the end of the business period. You know. So you go further, open your accounts. You purchase accounts, as usual, debit and credit. And then you also get open Jane account. Now I have a little question for you. Who do you call Jane in this situation in a business? Don't forget, we bought goods from Jane on credit. So Jane becomes the guy that the business is owing some money to. The business is owing Jane. So, and whoever that you are owing is called a creditor, is called a payable, and of course you know that to be a liability. So Jane account is a liability account. And I can decide to start with the purchases and say, okay, what do I do with my purchase account? Am I going to debit purchase or credit purchase? This is very easy to answer. Purchase, don't forget, is an expense. Anytime you buy goods in a business, you're making an expense or you're incurring an expense. Now your rule says debit expense. So anything that is expense must be on the debit side. So I come here and say 1,000 coming from where? That is in a transaction with Jane. I got my first entry right, so my second entry can never get to bother me because all I have to do is to apply the principle of double entry, which says that for every debit entry, there must be, okay, are we together? For every debit entry, there must be a corresponding credit entry. So now that you have your first leg correctly treated, what you just have to do in the second leg is move this figure to the opposite side of Jane's account and you get the answer correctly. Always 100% of times, okay? 100% of times. So this gives you 1,000 coming from where? Purchases account. Very simple. Then alternatively, you can ask yourself, who is Jane? Jane is a creditor, Jane is a payable, Jane is somebody that the business is owing money to. And whatever money that the business owes is called liability. So Jane is a liability account. Then go to your model. The rule says on the credit side, you always got to have PIL, which is payment, incomes, and liabilities, and by way of extension, you've got equity as well. So for that reason, Jane account is a liability. It must be on the credit side. That is why you have $1,000 on the credit side. You know, this works just like magic. Okay. So I proceed to my journal entries and say, I've got the purchase account to be debited. So you say debit purchases account with a match with $1,000, and you say credit Jane, you credit Jane account with how much? With $1,000. That is what you put in your journal entries. And if you're working with an accounting software, this is the instruction you have to input into the accounting software. You say debit purchases, credit cash, and it takes it off from there and posts into all the accounts where the posting the entries should appear at the end of that. So this is how to handle your postings, It is very simple. Always remember your HEAP model. This is going to guide you through the whole of accounting from the very foundation level to the most advanced and the final level of accounting. You get to continue to apply the principle here, PIL, here, PIL. Here, that is expenses, assets and received, and PIL, payments, incomes, and liabilities. Thank you very much for watching. Goodbye.